welcome to this Bennett Explains finance video. This week, what's in the financial pages part 2, dealing with bonds. Now if you missed part 1, dealing with shares, that video is available at BennettExplains.com, and also at that site, if you click on the bonds tab in the top left hand corner, you'll get lots of background on fixed income securities that I'm not going to cover here. So with no more ado, a brief reminder about bonds, and then what's in a typical bonds table and how do you make head or tail of it. Okay, so a reminder, bond basics. Now bonds can be issued by governments looking to solve the problem, which is that income from tax is often less than what they want to spend on health, defence and so on. So the difference is borrowed by way of an IOU called a gilt. Companies also issue bonds as an alternative to a standard loan. Imagine you're a company, you could raise from external sources £50 million by way of a loan. Now bonds are similar to loans, just as a reminder. Investors basically hand over money, they receive a coupon over a fixed period of time and they get money back at the end. So imagine, rather than borrowing £50 million from one bank, you could turn it into £51 million individual IOUs called bonds and then sell tranches of them to different investors, and those investors would be willing to buy these IOUs, put money into the bond market as it's called, because what they're looking for is an instrument that maybe carries a little bit less risk than shares but offers a bit more of a return than plain old cash. And in other videos I deal with the problem of storing wealth in cash. So for an investor, the deal is money goes in, regular income is normally received and it's usually fixed, hence the expression fixed income security, but it doesn't have to be. So as an investor you receive a regular income stream at predetermined intervals, half a year, yearly, whatever it happens to be, and at the end you get your money out. All right, and this is a different deal to buying shares. Many reasons for that, but one of them is if you buy a bond and hold it all the way through to maturity, you know exactly what your return will be to the penny or pound, unlike with shares, provided the issuer doesn't go bust, of course. And that means that if you've got a portfolio made up of individual bonds that you're prepared to hold all the way through to maturity, there's no doubt about what your expected return should be. So there it is, bonds. Now, if you're somebody looking at these IOUs, looking at bonds, how do you make head or tail of a standard data table that you might see at the back of the FT, you might see on a website, you might discuss with a broker, okay? How do you make head or tail of the information in there? Well, that's what I want to focus on now. Let's look at the content of a typical data table. Now, you could read these sorts of headings straight out of the FT newspaper, the bond section, towards the back of the market section as it's called, and you'll find this sort of data on websites. You won't necessarily get all of this. I want to give you a fairly comprehensive tour. So, first place you start obviously is the name of the bond. Now in there you could have a country, if it's a government issuing the bond, or you could have a company. You could say Tesco for argument's sake, if you've got a corporate issuer. Next thing you hit is the red date, the redemption date. Here, January 2021. Now most IOUs have one redemption date or maturity date. That's when the issuer plans to return money to investors. Okay, and the expression short, medium, long dated is driven by the distance between today and that date. So if it's near to redemption, short dated, a bit further out, medium dated, and if redemptions are a long way off, long dated. Why do you care? Come back to that in just a moment. Next piece of information, there's a reason these two are normally together, is the coupon. Here, 7.8%. Now, the coupon is not the yield. The coupon is not the return you get overall, because that's driven by the price. Just like the dividend yield on a share is driven by the price of the share as much as the actual dividend. But it does give you an indication, and these two together feed into something that I cover in another video called duration. And at the moment, that's an important word for bond investors, because in a nutshell, if you have bonds which have a long time to go until they're redeemed and carry a low coupon, they often have quite high duration. What does that mean? Who cares? It means they're relatively sensitive to changes in interest rates. And if interest rates start to move, the Federal Reserve starts to move rates, that's important for bond investors. Equally, bonds that are relatively safe in volatility terms, if nothing else, tend, on the whole, to have relatively close redemption or maturity dates and relatively high coupons. That makes them overall less sensitive to a change in the bank rate or the Fed rate or a central bank interest rate. So those two columns tend to come together and are of interest, definitely, to investors. And if you're not sure about duration, sounds like a bit of a technical word, do have a look at my video, Duration, a key word for bond investors. It's out there on killickexplains.com. So moving on, what else we got? We've got something called the rating here, and we seem to have 3 of them. Now this is looking at the bond's overall security, if you like. Professional ratings agencies, S, Standard & Poor's, M, Moody's, F, Fitch. They do a job which is fairly important in the bonds market. They're paid by issuers, worth bearing in mind, to rate their debt. And they do it by looking at the issuer. Some issuers, frankly, are safer than others from a default point of view, and looking at the bond itself, because some bonds are safer than others. Asset-backed securities tend to be safer than not asset-backed securities, for example. Now, they put a rating on using their own lettering system. They're rivals, after all, so they don't want to play the same game. But they, roughly speaking, they rank bonds from AAA, really safe, unlikely to default, all the way down to D, not surprisingly, which stands for default. And they grade them up in the middle using A's, B's and C's and pluses and minus, or little 1, 2, 3s, depending on which agency you're looking at. But in a nutshell, once bonds, this is a good example, once bonds start to get around to this sort of level, hovering in the low B's, then, to be honest, there are certain investors, institutional pension funds, for example, that will think twice about investing in them. Okay, so the rating's quite important. AAA, great, safe, solid, but may only carry a relatively small yield, of course. Risk and return, trade-off in this market like they do anywhere else, all the way down to D, high risk, default. Now, next, an indicative bid price, what you might, I stress might, be able to pay to buy the bond. And it's per 100, it'll be above or below 100, depending on market forces acting on the bond. If lots of buyers are in the market, bonds tend to drift above their nominal value, as it's called. And if demand is weakening, it'll be below. So it can be above or below 100. And that is important because it starts to tell you a little bit about what the yield might be. If you combine your coupon with the price, you get towards the yield. This is the annual return as a bond investor. So that's quite an important column, all right? The sort of anticipated expected yield on this thing, just below 7% in this case. If you're thinking, crikey, 7% per year, that doesn't sound too bad. Bank accounts at the moment are paying me 1% if I'm lucky. Bear in mind that there's no free lunch in investing. High yield assets tend to be higher risk than low yield assets, and you've got to weigh that up. And there is a way of weighing that up, just coming up in a moment. Now, some investors like to know how the yield's moving. So you've got the last day's change in there, should be a relatively small number. This gives you a flavour for volatility in this particular bond, this particular part of the market. You've got the month's change there. Again, relatively small number, given that you're looking at the change in a yield. And then you've got the spread versus US. What does that mean? That's quite important. That's another risk measure, if you like. In essence, what we're saying is that this thing offers a yield quite substantially above the equivalent US bond, let's say. And that's because it's riskier. So in financial markets, if you're offered a higher yield, given there are no free lunches or very few, it's probably because you're expected to take more risk. That applies in the bond market as a rule of thumb, like it does anywhere else. So the bigger that number on the right-hand side, the bigger the gap between what you're being offered to buy this thing and what you would get to buy something that's considered a lot safer, issued by the US, the bigger that is, the more risk there is within this particular bond. And it's worth watching not just the absolute level of that gap, but how it's changing. Is it widening over time, or is it narrowing over time? More risk, less risk. All right, so these columns are quite useful to the kind of investor that likes to make that kind of risk assessment. So you can see loads of information contained in a relatively straightforward looking table, easy for me to say, about this bond and some of its key risks. If you'd like to know more about that topic or any related ones, please do email me to the usual place.